Okay, let's continue on here with exercise 5-15. So we talked about the loss. Now the next one is the decrease in a receivable. So we see the receivables went from 185 to 180. That means that more people paid us back than owed us. So if you see over here, we see a decrease in receivables. We add to net income, and because we got money, more people paid us than owed us, so we got more cash. So that's why the decrease is an add. Then we have a decrease to our current liabilities, to our, let's say, accounts payable, for example. So that means that, let's look at it first. So current liabilities went from 151 down to 134. That means that people were paying us, paid us more than they owed us. I'm sorry. That means that we paid out our liabilities. We were using up cash to pay our liabilities. So a decrease in payables, right? Decrease in current liabilities. This means we subtract. I know I'm switching around a lot, but so decrease in current liabilities, we subtract. So we've got our adjustments now, and so we just take the 160. All these adjustments come to a positive 15,000, positive 17, positive 10, positive 15, negative 17, add them all up, that gives us a positive 17. So 160 plus the 15. So our operations had positive cash of 175. Okay, so now let's talk about cash from investing activities. So in this case, what investing activities are buying things that we need, and sometimes we sell things that we have, right? So we invested in a delivery truck and now we want to sell it or something like that, right? Or maybe we invested in stock and we want to sell it. So investing activities are typically negative, but sometimes when you sell some of those assets, that's where you get positive amounts that come in there. Okay, so we already said that we sold something. We said we sold investments. The investments went from 74,000 down to 52. That's the book value. But they were sold at a loss. Now we already got the loss part on the books. So what we want to figure out is how much cash we got when we sold those investments. Let's see. This is the book value. It went from 74 down to 52. That's a difference of what? 22,000, right? 74,000. So did we get 22,000 in cash? Well, no, we couldn't have. We got rid of 22,000 in assets, but we got rid of them at a loss, a $10,000 loss. So that means we must have only got 12,000 in cash. See, we went from 74 down to 52. That's 22,000 in assets that we sold. However, we didn't sell them for the book value of 22. We sold them at a loss, a $10,000 loss. That means we must have got 12,000 in cash. Notice how the statement of cash flows works. The gain or loss is included here. That's a non-cash situation that we took off the books. The amount of money that we put in our pocket goes here. Now we also bought something, right? It says let's see, equipment went from 240 to 298. So we bought equipment. No equipment was sold, so we just bought it. So all we did was buy it. So 58,000 in equipment. That's a negative. We used money. So our total effect on our investing activities was 46,000 negative. We used up 58,000 to buy equipment. We sold some equipment or some other kind of investment and got cash of $12,000 in our pocket. So the net difference was 46,000. And this is pretty typical to see a negative in investing activities. Financing activities are typically positive because usually you're getting cash from like people investing in your business or people that have loaned you money. So if you go to a bank, they give you a loan, it shows up here. If you sell your company's stocks in an IPO, an initial public offering, or you, let's say you're not a corporation, but you get investors to invest in your business, it would show up here as a positive cash coming in. But if, let's say you don't need any cash, let's say you've been operating for a long time and you didn't need any investors or additional loans, then typically this will be pretty empty unless you had to pay a dividend to those prior investors or unless you had to pay some of that interest. In this case, all we had dividends that were paid, and that was it. So the dividends are $30,000. There weren't any other things come in for financing. So we have a negative in financing. So if we take the 175 from an operating, we subtract out the 46 from investing, and we subtract the 30,000 in the financing. Our difference for the year means that our cash went up by 99,000. This minus this minus this, 99,000. We started the year with 78. We have to end with 177. That's what we know we have. So our cash flow statement needs to show that. And luckily it does. The 99 that was the change for the year plus the 78 of cash that we started with, giving you 177, it ties to the balance sheet. So this number ties to the balance sheet. If it doesn't, you're not done. You have to figure out why. The only thing else we have left is something called free cash flows that they want us to do an analysis for. Free cash flows is net cash from operating activities, so that's 175, minus any capital, anything like a big ticket item like equipment or buildings or something you bought. We did buy equipment of 58, so you subtract that and then you subtract dividends. In this case, we did have a dividend of 30. So our cash from our free cash flow analysis shows free cash flow of 175 minus 58 minus 30 equals 87. Free cash flows is an analytical tool to help us understand our ability to take advantage of opportunities. If something comes up, do we have the cash to jump on it, right? So that's what it kind of provides us with. If we're an investor, it kind of gives us flexibility or how nimble the business is. And it also helps us understand risk a little bit too. Having the proper amount of cash lowers your risk. All right, that's the end of that one.